Hi all, welcome to our channel. So today we are gonna discuss, how you can catch these massive rallies, the way we have seen in Bitcoin and Nvidia. Did you notice that recently Nvidia, Bitcoin had a huge rally, and many people they felt that they miss on participating in this rally. um, some of them had an idea that yes, these things may do well, but didn't invest due to certain kind of fear or indecision, and missed out on these rallies. So in this video, we are going to discuss how you can spot a stock or investment which has a huge upside potential, and how you can ride that rally or make sure you are making the right investments uh, to have a good financial and economic gain. Make sure you stay till the end so that you don't miss any of the important topics. And please do like and subscribe this channel if you find it valuable. Let's dive into some of the reasons why people, don't invest in certain stocks which have huge potential. So first is, they have a fear of losing money. Okay, like this stock or investment shows a lot of potential, but what if it goes southways? What if I lose all my investment? So that is the biggest reason why many people don't invest in certain possibilities. I have seen, or even I have seen, like people losing a huge amount of money, 40, $50,000 or even more, by investing one stock or a trend which they thought will go up, but it never happened. So definitely it is a risk, and one has to prevent themselves. Now, second reason is that they are not sure about the trend. What if, like so for example, Bitcoin, right? Few years back, everybody was worried. What if some regulation comes in, they stop Bitcoin and things like that. Nvidia, people were still not sure that how it will pan out. What if they get competition, and what if it doesn't scale up as people are imagining. So not having faith in an investment is also a reason why many people don't invest. $1 million question is, what should you do in future? How you can make sure that you are not losing these great opportunities, at the same time not risking your hard-earned money or savings. Step one is to do your research. The more knowledge you have, the more confident you'll be. Make sure you understand that there are fundamental reasons why you feel this company will go up. Maybe there is certain trend like electric vehicles or certain kind of a thing which everyone is um, promoting, and you feel this investment has a potential. Don't follow like the kind of a trends like GameStop, where kind of everybody knew that this company doesn't have a potential, or now um, there are no fundamentals which will support growth of that stock, but still like uh, people were able to make money for short term out of it, but it's not how you should approach your investment. So step one, do thorough analysis, and so that you are confident that yes, it has a potential. Step two is like find out how much can you risk. So for example, if you invest certain amount and all of it went to zero, how much impact will it have to your financial planning or future and things like that. So as a general rule of thumb, many people what they do is they set aside certain sum, maybe around 5% or less, in these kind of opportunities which they feel have a high potential but have a high risk also. So many people, they'll invest majority of their money in investment that they are kind of pretty confident about, whether say it's a real estate, or it is say investing in index funds. So there are like certain things where that over a long period of time you can expect a certain amount of gain. So for example, in an investment, right, like if you invest last 50 to 100 years, it has been giving kind of 8% plus return. So, I mean, though it is not for sure, still you can be a little confident that yes, it and when invest majority of my money in this, I can expect to get, these kind of a returns. Or real estate, like, people who are expert or have done good analysis, they know that okay, I'm going to make certain amount. Even in worst case, I can, sell the house and get this much back. So these are kind of more seasoned investments or things which you are more confident and will give certain amount of rate of return. So majority you should invest in things which works and set aside a small percentage, say 5% or less, in this kind of investments which you feel has a high potential but has a high risk as well. Step three is what we call as dollar cost averaging. So if you know that okay, this particular investment or stock is going to do good, then invest a small amount over a long period of time. What it does is first it averages out the cost, and in a longer run, you can reap benefit. It's in most of the cases it's good to have a strategy where it is automatically investing and you don't have to think or make decision, because then your emotions gets kicked in. And personally, I also did same thing with Bitcoin. Uh, eh, for last few years, I have been investing small amount, and I was okay to lose all that amount if something goes wrong. But luckily, it panned out, and now Bitcoin is giving great result. So definitely do dollar cost averaging, so that in a longer run, if a rally happens, it in the growth of that. Next step is to monitor and reevaluate. So yeah, over a period of time, things change. And now if you feel that this investment class does not show, potential as you thought initially because of certain reasons, certain announcements or whatever, right? Then you should reevaluate whether you want to continue investing in this asset, or maybe stop investing here and invest somewhere else, or maybe take out your money in some cases and cut your losses. If we have to kind of quantify this, right? So for example, assume someone has $100,000 to invest, and they put 5% in a risky asset and 95% in an asset which they feel is going to give um, a certain amount of return, say 10%. Uh, so that $95,000 will earn them, around 9,500. And this 5% investment, if it even if it goes down, they have that like uh, return on top of their $100,000 which they invested. So 5,000 is gone, but still out of that 9,500 income, if you remove 5,000, you still have 4,500 positive overall on your 100,000 investment. But on the other hand, if this $5,000 risky investment is paying off and it goes up by say four times, 30,000 here, so almost 15,000 gain here and there 9,500. So a huge amount of gain you are able to accumulate uh, by allocating a small amount of your investment portfolio here. So I hope it makes sense. And I have kind of caught some of these strategies by reading a lot of books and following certain people, and I'm open to learning your thoughts or what you feel about it. If you have any comments, please feel free to leave, and subscribe and follow this channel. We'll be sharing more informational videos. Thanks. Bye bye.